am Kim Snyder, and thank you so much for joining me for the Sane Crypto Podcast, the first cryptocurrency podcast for baby boomers investing for retirement. Most people believe that crypto assets are too risky for the average investor. I believe that the risk is in not investing, and that in fact, cryptocurrency may be the answer to near retirees' prayers. The Sane Crypto Mastermind is my signature program for those who want the diversification benefits and return potential of cryptocurrency, but can't, won't, or just don't have time to figure this all out and keep up with it on their own. If you'd like to learn more, I'd encourage you to join my free online training called How a Little Bit of Bitcoin Can Make Your Retirement Savings Go a Lot Further at sanecrypto.com/retirement. I was being interviewed last week for a podcast, and one of the questions that the host asked me was, what are the 3 biggest mistakes that new cryptocurrency investors make? And my answer, short answer, was wrong timing, wrong thing, and wrong amount. Meaning they buy tops and sell bottoms. That's wrong timing. They're investing in ICOs and altcoins that are almost certain to lose them money. That's wrong thing. And they invest way too much of their investable assets in cryptocurrency. That's wrong amount. And in, explaining or expounding on that answer, I remembered an interview that I had done for my radio show back in, as it turns out, it was late 2009, with Dr. Leonard Mlodinow, who is the author of a book called The Drunkards Walk: How Randomness Rules Our Lives. So I dug out that interview and re-listened to it, looking for one specific example that he had used. And then I decided it is so good that I would just share it with you as well. So just to give you some background, Dr. Leonard Mlodinow is a theoretical physicist and author recognized for groundbreaking discoveries in physics and a passion for making science accessible and interesting to the general public. He was on the faculty of Caltech and is the author of 5 bestsellers. Among them, The Grand Design, co-authored with Stephen Hawking, took the reader on a tour of the latest ideas in physics and cosmology and was a #1 New York Times bestseller. His book, Subliminal: How Your Unconscious Mind Rules Your Behavior, described how a person's thoughts, decisions, and feelings are profoundly influenced by the behind-the-scenes operation of the unconscious mind, which won a bunch of awards. And his book, The Drunkards Walk: How Randomness Rules Our Lives, which is the one we are talking about, showed how the hidden forces of randomness have a huge and generally unrecognized effect on all aspects of life, as well as the course of companies and societies. That one was chosen as a New York Times notable book and shortlisted for the Royal Society Book Award. In this conversation, we talk about why rats are better at probability than humans are. How do we know that markets are random? I always say that, but how do we know? How does a drunk walk? How many times do we have to play the World Series to know statistically which team is better? And if the market is random, how is it that fund managers and day trading courses still exist? As always with these throwback interviews, please forgive the fact that this was recorded 10 years ago over a landline. Remember those? When our technology for recording calls was still pretty kludgy. But with that, enjoy my interview with Dr. Leonard Mlodinow.
This is not a book about finance and investing specifically, and yet I believe it's a very important book for anyone who invests their money to read and be familiar with the concepts. Tell us, if you would, a little bit about the book and what it's about and why you wrote it.
Well, I started out wanting to write a book about entropy, actually, which is a physics concept, and soon I decided to broaden it to randomness. And as I was thinking about what I would put in the book, I realized that the most interesting applications were applications in daily life. And around that time, the 2002 Nobel Prize for Economics was given out to Daniel Kahneman and another. And Kahneman got it for his work with a fellow who was deceased named Tversky. And their work was about the applications of randomness in economics. And the interesting thing that got my attention was that they were psychologists. So they were giving a Nobel Prize for Economics to psychologists, which is, needless to say, not normally done, but it showed how important the misunderstandings of randomness are in the economic world, and that really spurred me on to look at some of the research, and I got more and more interested and ended up writing the book primarily about how we misunderstand randomness and misinterpret the events around us, make poor decisions, and how our intuition is for random events is very, very bad, and how we could improve our see the world in a different way and improve our decisions if we understood randomness better.
Now the book is absolutely chock full. You are a great writer. You make a subject which would normally be somewhat intimidating and dull very interesting because of your use of anecdotes and current events. So perhaps you could give us one or two examples of how we misapply randomness or misunderstand randomness. Two of your favorites from the book.
Well, I guess what you ask about applications, but what come to mind are a couple of experiments that illustrate, not necessarily real world application, but illustrate in the laboratory how people misunderstand it. And one of them is a experiment where they compare a person and a rat. And what they do is they take the subject, either the person or the rat, and they show the subject a series of flashing lights. The lights are either green or red. And they're designed so that, let's say 75% of the time it's green, and 1 out of 4 it flashes red, but they're shuffled randomly other than adhering to that percentage. And they just don't tell or indicate to the subject anything about this. They just show them the lights, they watch for a while, and after a while they ask them to guess, is it green or is it red? And in the human case, they're getting a reward. I remember, I think it was some monetary reward based on how many they guess right. And in the rat's case, they get a little, I think, sugar water. And the interesting thing is that when the people do this, almost everyone tends to mix up their guesses. They guess green sometimes and red sometimes, and they guess in proportion to what they felt the percentage has been. So they'll guess, let's say, 3 out of 4 times they'll guess green, and 1 out of 4 red, and they'll shuffle it and try and get the right answer. And if you could predict the future, then that way you could get one. If you do it that way, you could get 100%. But since they're random, you don't have much success that way, and actually the rat ends up outperforming the human, because the rat sits back and just goes, oh, they're mostly green, I'm going to guess green. And the rat, which doesn't have this same propensity to look for patterns, will just guess green every time. And mathematically, if you do the calculation, a person guessing the way I described and a rat guessing green all the time, the rat will win.
Hey y'all, 2018 Kim here, jumping in from the editing booth, which I promise I won't do a bunch of times during this interview, but I did want to make this one point because I think it's important. In fact, that study about the rats was the very thing that caused me to go back and pull this interview out because I had forgotten the details of it. I just kind of remembered the general substance. And what it, of course, reminds me of, if you listen to any of these Facebook groups or even some of the podcasts where people are talking about, buy this ICO, buy that ICO, buy Bitcoin, now sell that one. It's, that it's basically the red lights and the green lights, as opposed to, which is what I was explaining on the podcast as I was being interviewed. If all you do is hold something with a much higher probability but much less exciting, like Bitcoin and possibly Bitcoin or some Ethereum, because that's the green light, you are going to outperform. But that is the hardest thing for our brains to do. So anyway, just wanted to make that point, and now back to the rest of the interview.
So this is one example of how people tend to search for patterns, and it's really inherent in our minds. There's another study recently that showed that if it was a similar kind of experiment where they're showing something repeated, and after just 2 repetitions of a pattern, a part of your brain that looks at patterns starts to kick into action. And it's very complicated to understand exactly how it works in a person, but they've done the experiment with split brain patients where one side of your brain doesn't communicate with the other, and if you do the experiment and the left side of the field of vision versus the right side, you can essentially do the experiment separately on the 2 sides of the brain in the split brain patient. And they found that the 2 sides of your brain actually come to different strategies. One side will do the rat strategy, one side will do the normal human strategy, and it's that side that, for most people, wins out. So it's complicated, but it seems to be built in, almost hardwired into your brain to look for patterns, which is why we look in the sky and we see, the face of Jesus, or during the World War II, there were when the Germans started shooting rockets at London, they had no particular guidance system. They were just lobbing them at London. But when people looked at where they were hitting, they got very worried because there were clusters where it hit that they actually had pretty good guidance systems. But clusters tend to happen in random patterns, and people have a hard time accepting that, and so they misinterpreted that. So that's one whole area that I talk about in Drunkards Walk, which is how people are built to look at patterns. And in the case of me and other scientists, it's great because we can be physicists and we can get very far. But we have mathematical techniques to help us determine what's really random and what's meaningful. The other study I wanted to talk about was another one where this shows how people believe, even when they know that something is random, they believe they can control it or predict it. And this was done at Yale University. They showed students coin flips, and they asked them to guess the coin flips. And of course, intellectually, the students knew that they couldn't guess the coin flips. So you couldn't. Do you think you can guess coin flips and get an honest, emotionally honest answer? Because intellectually they knew that they couldn't. But they asked them some slightly more subtle questions, and they weren't extremely subtle, but slightly more subtle. And it was amazing that a significant number of students seemed to believe that they could predict coin flips. For instance, they asked them if their performance would improve with practice, and a significant number said yes. Or if they would do worse with distraction, and a significant number said yes. So that shows that on a gut emotional level, people do, even if they intellectually know something's random, they feel they can predict it. And those are the kinds of things that get in our way when we look at the world around us and we see what seem to be patterns, and we may even intellectually know that we can't trust them, but we act as if we can.
Well, and the immediate thing, seeing as this is a financial show, and the immediate thing that comes to mind, of course, is the fact that stock prices are random, and yet most of the financial services industry is based on the idea that someone can, in fact, predict what's going to go up and what's going to go down, right?
Right. Of course, I'm sorry. Go ahead.
No, go ahead.
There's always the fine print that says that the past doesn't predict the future, that no one can tell, but that's not the message they give you, and people are fooled. And what really irks me, also as an investor and as a consumer, is that they charge much higher fees for that. So if you're looking at a mutual fund and you take a managed fund where you believe people can do well, you'll pay a lot more than if you just take an index fund that depends on the average movement of the market. And you're paying for not only the $1 million bonuses and the $1 million salaries, multi-millions, and you're paying for a lot of hard work and research that people are actually doing. But essentially they're just spinning their wheels, and it's all an illusion. And I have a couple examples in the book. One is a nice one where I have the top 800 mutual funds over a 5-year period ranked from 1 to 800, and on the horizontal axis I just have the ranking at 1 on the left all the way down to 800 all the way on the right, and on the vertical axis, rising above the horizontal, is the return that the fund got in that 5-year period. And what's interesting is, okay, when you do that for a 5-year period, of course, you get a very nice smooth curve, very high for number 1 fund, and it gradually lowers, moves down to the 800 fund, and it's a very nice looking smooth curve, and it looks very orderly. And of course, before I wrote this book, like everyone else, I would look at the last 3 or 5 years of a fund and go, oh, this one's doing really well, I'm going to buy that one, right? And it's very hard to go against that idea because you're looking at this nice pattern, and you believe that things can be predicted, and you know that they're working very hard at it, and it's just hard to say that that's meaningless. But then I have another graph with the same 800 mutual funds, same ranking, for the following 5-year period. So if the past predicts the future, if this reasoning is correct, that you can look at the last 3 or 5 years, and that will tell you what's going to happen in the future, then you should see a pretty similar chart, very high on the left and same kind of a shape going down to low on the right, because the good funds are good and the bad funds are bad, and it can all be predicted. But if it's all random and they don't really know what they're doing, you could still get the first chart, right? Because if everyone's just flipping coins, you're still going to have, over those years, some that do, by chance really well and some that do poorly. The difference is that if it's random, if you look at the next 5 years, since the first 5-year graph was just something that I sorted out by arranging them from 1 to 800, it's really meaningless. So the next 5 years, it's going to look like random noise, because the past does not predict what's going to happen in the next 5 years. So if you look at the chart for the next 5 years, if it's random, it should just look like random noise. So what does it look like? Well, you can guess already. It looks like random noise. So you're not predicting anything by picking the number one fund or the money that you're paying for their success. And that's just a big mistake people make. As long as we're talking about funds and randomness, let me talk about Bill Miller, who I guess you remember that part of the book where I talk about his great fame. And he became extremely famous and was, a media darling because his fund beat the Standard & Poor's 500 index for 15 years straight. And all sorts of articles were written quoting, the great odds against this and what a lion of finance he was, that he could tell exactly which stocks to pick over all those years. The odds people quoted against doing this at random were somewhere between 1 billion to 1 and 200,000 to 1. I'm not sure how they got those odds, but seeing those odds really got me thinking, that's actually not a bad thing to do, is to calculate the odds, because in science, if we looking for a certain effect, and we do a laboratory experiment like the two I mentioned earlier, you don't just say, oh, look, we see this effect, it must be meaningful. What we do is we compare it to a control group where we say, what are the chances we would see the same effect if it was just by randomness alone? So it's a good thing to say, if Bill Miller really has skill, then if we do a random model of the same process, we should see that the odds are 1 to 2 billion to 1 that someone could do that by chance alone. Whereas if it's all random, like the graphs that we talked about indicate, then I should be able to calculate that if people were doing this, were picking stocks by chance alone, then there should be a pretty high probability that would happen. So I made a random model. I said there's about 5,000 or 6,000 mutual fund managers today. But in the past there were less, and I just didn't want to be accused of inflating the number. So I just took a round number, 1,000. Let's say there's 1,000 mutual fund managers. And let's say over the period of modern mutual funds, which according to one of these articles was 40 years, all 1,000 of these managers were trying to beat the Standard & Poor's, but their chances were determined purely at random. Each one would just flip a coin once a year, and if the coin is heads, we say they beat the Standard & Poor's, and if the coin is tails, we say they didn't beat it. So for 40 years, you have 1,000 managers flipping a coin once a year, and I calculated the probability that someone among them would beat the Standard & Poor's or would get heads for 15 or more years in a row to have the same kind of feat as Bill Miller. And guess what? It wasn't 1 billion to 1. It wasn't 100,000 to 1. The chances were 75% that by chance alone someone would have achieved that feat. So I always said, I think I put this in the book, that one of the headlines said, Bill Miller, greatest mutual fund manager of all time. And I'm thinking what it should have said, if the media really understood this correctly and was doing a service to the public, it should have said, expected 15-year streak finally occurs, Bill Miller, lucky beneficiary. But I didn't see any headlines like that. And sure enough, of course, once his random streak broke, he hasn't done so well after that. I mean, he's back to randomness, and in the last couple of years, he's actually severely outperformed the market and ended up picking stocks like AIG and Bear Stearns. And I don't blame him for that because, again, nobody really knows. And I don't blame him also for his great reputation. That wasn't him applauding himself. That was the ignorant media applauding him. So your show is accepted, Kim. You're not like that.
No, I am not like that. I try very hard to get people to understand the randomness in our markets, because I think that's central to being successful as an investor. The title of your book is The Drunkard's Walk. Perhaps many of our listeners don't really understand what a drunkard's walk is. I know many of them because I've had Bert Malkiel on the show. They've heard of the random walk down Wall Street. But explain that for us real quick, and then I want to ask you about the law of small numbers.
Okay, sure. Well, it's exactly that, actually. The Drunkards walk is a mathematical term that's synonymous with the random walk. So if they've heard Malkiel, they'll know what that is. But it's just, let's say, on a tabletop, it's a path where if you're moving, you change directions at random. And the reason I call it the Drunkards walk rather than the random walk. I thought it would be a more appealing title, and people might identify more with the. There were many titles I went through that could have sounded like textbooks, and since I wasn't writing one, I thought this would be better. But the reason it's a good title, it's actually a metaphor for our lives. I mean, not just in finance, but in our personal life and in our personal relationships, in medicine and in law, and I mean all the other areas I cover. It just seemed to be a very good illustration of what's happening. Because if you look at a Drunkard's walk, you'll find three properties that are really relevant to this discussion. One is you'll start at some point, and you'll end up at some point a distance away. So even if you're just moving at random with no intention and no direction, you'll get somewhere. So if you see that someone ends up somewhere, we normally assume that person had an intention or a talent that got them there, like Bill Miller. And the answer is no, that way. It might be, but it doesn't have to be. Another thing is that if you look at the pattern, if something's moving at random, you'll find there are periods where it's moving in the same direction several or many moves in a row. It seems to be going somewhere really directly. Again, that can be at random. Even if you're throwing a coin and it's heads, tails, and 50-50, sometimes you'll get a series of heads in a row, and that can be random. Just again, like Bill Miller or like the graphs we talked about. And finally, it comes to clustering. You'll also find that in this walk, there are times when it seems to hang out somewhere and just stays in the same place. And again, that doesn't mean that it wants to stay there. Those things can all happen by random. And, this is a talk for another discussion or maybe another show. But, cancer clusters are like that. You have to be very careful when people identify that there are high cancer areas in an area somewhere, high cancer rates somewhere, that it could very well be by chance. It can be striking how high the concentration of cancers can be, and it can still be by chance. So that's a subtle discussion that takes some thought. When we see a cluster like that, we shouldn't automatically assume that it's real. So the Drunkard's walk was a good illustration of all these different effects that go on.
What I love about this book is that it isn't just finance and the many different areas that you cover. Not only do you cover a historical kind of walk through time and how we discovered the truth and the laws of probability and chaos and statistics, but at the same time you take everyday events in our lives and some of the the O.J. Simpson trial and some of the things that we'd all be familiar with and pull the lessons out of those things. I love that, and as I said earlier, it makes it a very readable book. So what I said to you before we went on the air is, I could sit here and talk to you for hours about this book, and I think it would all be really useful for our listeners. But since we don't have hours, I want to just pull out one real specific error that we make, and that is the law of not large numbers, which is a real law, but rather the law of small numbers. Could you explain that to our listeners?
Sure. The law of large numbers, as you say, is a mathematical law which says that if you have something that has a certain probability of occurring, that if you run the experiment or the trial many, many times, a zillion times, that the chances are very high that the outcomes will reflect the underlying potential or probability. So if I have a coin that's weighted, let's say 53 to 47, 53 heads, if you throw it 10 million times, you'll see approximately 53% of the time it'll come up heads, and you'll be able to tell that it's weighted. The problem is that doesn't work for a small number of times. If you throw it 10 times, you can't tell. If you throw it 10 times and it comes up head 7, you're very shaky saying that it's weighted 70% heads. And although people might think they understand that, they really don't act as if they do. And that's what psychologists call the law of small numbers, which is the mistaken application of the law of large numbers to small numbers. So, for example, if you take the Fortune 500 companies, and let's assume that in some parallel universe they are all identical quality. So I'm not saying quality, by the way, doesn't matter or talent doesn't affect things, but I'm saying that both that and randomness affect things. And so what the law of small numbers tells you is that the results do not normally reflect the underlying quality very accurately because we don't have enough to go on, enough data to go on. So in this example, let's assume that we have a universe where every Fortune 500 company has an identical probability of success, which is 60%. And let's look at them over a 5-year period. So a 5-year period, if you have a 60% chance of success, you would expect to be successful 3 out of 5 times. That would be if results reflect potential. So if results accurately in the world reflect potential in, let's say, series as short as n equals 5, then you would expect all 500 companies to do, 1 year or another, they'd do better, they'd do worse, but they would all have 3 out of 5 good years. On the other hand, if results in a small number of trials don't reflect the underlying potential, then it wouldn't work that way. So again, you can do the calculation, find out how does it work. And what you find is that only 1 out of 3 times will a company with a 60% chance of success have 3 out of 5 good years. So of those 500 companies, only about 166 will have 3 out of 5 good years. All the remaining companies, with the vast majority, will have 1 or 2 or 4 or 5 or 0 good years. So they'll all have success, all over the map that look different. They all look like they're different companies. Some look better, some look worse. About 1 in 10 will have a streak of 0 or 5 good or bad years in a row, and they're all identical. So what that shows you is you can't look at the results over a 5-year period and separate the companies, which ones are the good ones and which ones are the bad ones, because it's just not reliable. And you might ask, how long do you have to observe? How many years will I have to observe the companies, assuming that conditions won't change over those years, and when I'm done, I can use that data, right? Well, it's mind-boggling how long you have to observe. So let's say the World Series is coming up soon, and it's best of 7. And let's say that the better team has a 55% chance of winning over the lesser team. And that's a pretty lopsided chance because usually the teams are much closer. And again, just like the Fortune 500 situation, now we're doing a test of 7 games, right? And the question is a 7-game test enough to see which team is better? And the answer is no. And under those circumstances, the lesser team will still win 40% of the time. So you're fooling yourself 4 out of 10 times if you assume that the better team is really, that the team that wins is really the better team. So the question is, how long, when you say the law of large numbers versus small numbers, where's the demarcation line? How long do you have to observe? And in the case of the baseball series that I just said, you'd have to play a series best of, guess what, 269 games to have what's called a statistically significant decision as to which team is better. That means that the lesser team wins 5% or less of the time. So in real life, we don't normally have 269 quarters or years of observation, right? Or if an employee is applying for a job, we don't have 269 events on the resume that we can analyze. And in all our life, we very rarely come into any situation where we have that much data. And so the point is, you can't judge the world by the results. You have to look deeper and you have to think a little.
Well, and let me tell you my view of where that collides with the real-world investor. I think for various reasons, part of which is the press and the 24-hour news cycle, investors' time horizons in terms of the time horizon that they inspect, if you will, is getting shorter and shorter and shorter. Used to someone looked at their portfolio once a year. Now they may look at it once every 5 minutes. They've got a ticker going across their computer screen. And what they're really doing is they're applying the law of small numbers or those small number of observations to something which takes a much longer time period to play out, just as you described, and saying, this is broken. This isn't working. You told me it would do X, but in this time period that I'm watching, it's doing Y, and therefore either you lied to me, it's not appropriate, or it doesn't feel good to me, therefore I'm going to sell it, and do something else. And what we know is that it is that consistent selling low and buying high that some people would say is caused by fear and greed, and there's no question about that, but it's also caused by this application of the law of small numbers. And it causes them to badly underperform their investments. The investor typically gets a worse return than the investment they are invested in because they can't wait for enough games, as it were, or enough quarters or enough events to be able to make a judgment about about its efficacy.
I agree 100%.
Yeah.
That is a major sickness.
And for those of us who are trying to help people do well as investors, because now this isn't just something that is for sport, it can mean the difference between having a decent retirement or living under a bridge and eating cat food in your 90s. The outcome is important. It's meaningful, and so it's just so important for people to understand that the mistake that they're making. But what I find is it's just so hard for people to wrap their brain around the fact that this is random.
Right, it is hard, and even when you know that something's random, and you say, okay, I get it, I listened to the show, I read the book, I understand, I can do it. It's still very hard to do. I mean, I have there are many experiments I describe also in the book where people are told that something's random and they still make the mistake. There's one where two fellows are working and solving an anagram, and the subjects don't realize that they are really actors, and actually they're watching a tape. They're not really watching it, on a monitor, as they think in real time. And everything's been designed so that these two guys who are solving the problem have equal contributions as they cooperate to solve the problem. And the thing is, there's three groups of subjects. One group's the control group. They're told nothing. They just asked who did better, and they say 50-50. Some say Bill did better. Some say the other guy, Ted, did better. The second group is told that there's a certain amount of money they can pay the volunteers, but it's not much. So to make it worth something to somebody, they picked Bill at random to give him the pay. And the other group is told that at random they're paying, Ted is being paid, but they're both told that don't just ignore this pay, it's meaningless. We're just giving it to the person at random. Okay. Well, when they give it to Bill, and then they ask them the same question, who contributed more when they watched his anagrams, the people were told that Bill's being paid, 70% say Bill did better. When people were told Ted's being paid, 90% say Ted's doing better. So unconsciously, they're feeling that the person who's making the money must be better, even though they know that they aren't, because it's random. So it's very hard to resist these temptations or these intuitions. So what I recommend for many people is if you realize that is, I do recommend using professional investors as long as they're low cost, low fee, and they invest. They don't pick stocks or try to time the market. They just help you manage your money and help you resist selling low and buying high based on emotion. If you need help with emotion, that's a good thing to do. But I'm very much against anyone who tries to pick stocks or time the market and charges fees for that.
I have one last question for you, and this may not be a fair question, but you've clearly given it some thought, because you do have the section in your book where you talk about the application of this to mutual fund managers and so forth. There are a lot of managers out there active managers who pick stocks and or time the market. Do you think that those people believe in their ability to do that? Or do you think they are fooled by randomness, to steal the title of Nassim's book? Or what are your thoughts about why we continue to offer active management when empirically it is just luck, not skill?
I think that I'm guessing that most of those people do feel sincerely that they're doing something useful and don't accept that it's random. And they have monetary motivation to feel that way, which is not necessarily. I don't mean by that. I don't mean they're taking that the market is bribing them to feel that way, but they can legitimately feel that way based on the monetary motivations, and unconsciously they are influenced to believe this. And also they've invested a lot of time and effort into doing that, and that's those are all psychological factors that will change the way they view the world. And we don't have time to go into it, but I talk a little bit in Drunkards Walk. I talk a little bit about something called the confirmation bias, and how people, when it's in their interest or when under certain conditions, tend to look at different theories and the data supporting or refuting them in different ways. They weigh it in different ways depending on their situation and their own rewards that are at stake. And it's, again, unconsciously, though, it's not that they're saying I'm getting paid for this, so I'm God dang it, I'm believing it. They just do. So I think that they're sincere and they're fooled just as the people who are buying into it are sincere and they're fooled. And that's why they need to read books like this so that they can, those people who are actually doing it, maybe, some of them end up moving into and going into passive management or, the kind of people I'm recommending. But, others, maybe they shouldn't read the book because it could cause them internal conflicts.
And I think that's a great place to leave this interview. If someone wanted to get a copy of your book, which I am putting on my recommended reading list, it's available, I assume, in all the great booksellers as well as online still?
Yeah, everywhere in your great local independent stores. It's in Barnes & Noble and Borders, Amazon.com. It's at the airports. It's fortunately for me and my message, the book has it can be gotten anywhere, and it's so I'm happy to say that won't be a problem.
Very good. So once again, the title is The Drunkard's Walk, How Randomness Rules Our Lives, by our guest today, Dr. Leonard Mlodinow. Thank you again so much for your time, Leonard. I've really enjoyed our conversation.
Thanks, Kim. So have I.
All right. So we covered a lot of ground in that. Let me try to just summarize it for you really, really quickly. 1, rats outperform us at probability games because pattern matching causes us to see patterns where they don't exist. 2, almost all investments are subject to the law of small numbers, which says during any observable period, the results are likely to differ from the probability, but that doesn't change the probability, nor should it change your decision making, by the way. And then number 3, our brain assumes, because we're paying someone, think back to the guys being paid for the anagrams, i.e., because we're paying our investment advisors or our fund managers, that they must have skill. So as always, I hope that was helpful and thought-provoking. Speaking of thought-provoking, I'm sure if you're a podcast listener, you've heard me and other hosts ask you for iTunes reviews. I do read them all. It's very helpful feedback. In a recent one, Obadiah says, "Sanity. Love the podcast. Can't say enough about it. Great info, but also thought-provoking. It's really made me reflect on my finances and how to better manage them and think about them going forward." So first of all, thank you so much, Obadiah, if you're listening. I cannot tell you how much I appreciate that review. It's always nice to know that I'm hitting the mark. Hopefully this episode was no exception. Reviews like these don't just make me feel good, though they do, but they also tell the iTunes algorithm to show the podcast to more people by sending a very important social signal to the algorithm, as well as potential listeners, that I am producing quality content that my audience finds helpful. So, if that's you, please take a moment to do 2 things for me. 1, subscribe to the podcast, and 2, leave me a 5-star rating and a review with comments and feedback like Obadiah did and so many others have done as well. Also, if you would like to learn more about investing in crypto assets for retirement and my system for doing that, I recommend my free online training, which is how a little bit of Bitcoin can make your retirement savings go a lot further at sanecrypto.com/retirement. You can get the full show notes of this episode at sanecrypto.com/podcast. And then finally, if you have a question about today's topic or anything else, just email me at askkim@sanecrypto.com. I read and answer every single email personally, as well as answer some of them here on the show. Everything I say on this show is for educational purposes only. Nothing should be considered investment advice. Past performance is no guarantee of future results. All investments involve risk, so do not, under any circumstances, invest money you can't afford to lose. That is it for me. I'm Kim Snyder. I'll be back next week. Until then, may the crypto gods continue to smile on us all.